Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here.
So today we're looking at what really feels like a tale of two economies. We've got a whole stack of reports here from January 2026, and they're focused on, the two giants of Asia, South Korea, and China.
Right.
And looking through this research, it feels like we're watching two completely different survival strategies play out in real time.
Yeah.
Both governments are getting incredibly hands-on with their markets, but for totally different reasons.
That's really the headline, isn't it? If you grew up thinking the free market was just this, invisible hand, this is going to challenge that. What we're seeing in 2026 is the visible hand.
A very visible hand.
Heavy intervention. But you're right, the motivations are almost opposite. One is playing offense, trying to force a re-rating. The other is playing defense, trying to prevent any cracks in the system.
Okay, before we get into the weeds, I want to play devil's advocate for just a second.
Wow.
I'm sitting here in the U.S., I'm looking at my 401k. It's maybe you got an S&P 500 index fund in it. Why should I care? Why should I care about some pension fund rule change in Seoul or a bond issuance in Beijing?
Because it hits your wallet.
Without a doubt.
Really? Oh, absolutely. First off, if you own any kind of broad international fund, you literally own these companies. Yeah. But even if you don't, even if you only buy U.S. stocks, these are massive signals.
Signals about what?
About the health of the global economy. We're talking about the supply chain for the phone that's in your pocket. We're talking about the financial stability of the world's second largest economy. If China sneezes, everyone still catches a cold.
And South Korea.
If South Korea stumbles, the whole AI revolution, which is, let's be honest, driving the entire U.S. tech sector right now, it hits a massive speed bump.
Okay, so the stakes are high. This isn't just foreign news, it's global financial plumbing. So here's our roadmap for this deep dive. We're going to start with South Korea. The government there is on this mission to rebrand its entire stock market. They're trying to fix something called the Korea discount.
Which is, as you said, the offensive play. They want to boost asset prices, strengthen their currency.
And then we'll pivot to China. And that feels completely different. The analysis we have suggests they're preparing this massive financial airbag, billions in bonds, to prop up their insurance sector.
Exactly. That's the defensive move, reinforcing the walls before the storm hits.
All right, let's start with South Korea. I keep seeing this term in the financial press, the Korea discount. It sounds like a sales event, but I know it's not a good thing. What exactly is it?
It's been the central frustration of that market for decades. Put it simply, South Korean companies are just consistently valued lower than their global peers.
So like for like.
Yes. Imagine you're shopping for a dollar bill of earnings. If you buy a U.S. corporate dollar, you pay $1. A Taiwanese corporate dollar may be 95 cents. But historically, a Korean corporate dollar you could get for like 70 cents.
That sounds like a huge bargain. Why wouldn't investors just flock to that?
Because it was seen as a damaged goods discount. The perception was higher risk. Sure, there's a whole North Korea thing. That's always in the background. But the real issue, the one these reports are hammering on, is governance.
The cables, right. These massive family-run conglomerates.
Exactly. Samsung, LG, Hyundai. And the criticism for years has been that these companies are run for the benefit of the founding family, not the average shareholder. They might hoard cash instead of paying dividends, or do a merger that helps an heir but hurts you, the minority investor.
So Wall Street looks at that and says, I'm not paying full price if I don't get full rights.
That's it. The discount is the price of mistrust. But what's so interesting, looking at the data from this January, especially a note from Harold van der Linde at HSBC, is that narrative is starting to crack.
What's changing?
The story is shifting from valuation to earnings. For years, people bought Korean stocks hoping that discount would just disappear. Now they're buying because the companies are just making so much money. The profit growth, the earnings story, is finally overpowering those old governance fears.
So investors are basically saying, okay, the governance isn't perfect, but these profits are just too good to ignore.
Right, but it's not just the companies. The government is pulling some serious levers in the background.
And the biggest one involves the National Pension Service, the NPS.
Yes, one of the biggest pension funds on the entire planet. A total whale.
Okay, so what is this whale doing?
Well, for years, the whale acted like you'd expect. It would swim out of its home pond in Korea and buy U.S. stocks, European bonds, diversify globally.
Standard advice. Don't put all your eggs in one basket.
Correct. But in January 2026, the strategy shifted. The NPS announced it's adjusting its targets to lower its allocation to foreign stocks.
And buy more Korean stocks.
And increase its allocation to domestic stocks. They are bringing the whale home.
Okay, but why does that matter to an observer in the U.S.?
It matters because of the currency. See, when a Korean fund buys, say, Apple stock, they have to sell Korean won to buy US dollars. That constant selling pressure pushes the won down, makes it weaker.
And a really weak currency can cause all sorts of problems.
Exactly. So by keeping that money at home, the NTS stops that selling pressure. It helps stabilize the currency. And at the same time, they're becoming a huge, consistent buyer in their own stock market. It creates a floor.
It almost sounds like, is that market manipulation or maybe just state-sponsored support?
I'd call it aggressive statecraft, and they're not being shy about it. We saw President Lee Jae-myung at a press conference on January 21st. He was incredibly specific. He suggested the won could stabilize around 1,400 per dollar and just said outright that Korean stocks are still undervalued.
It's pretty rare for a president to give a currency target like that.
It is. It tells you the government is all in. They're sending a huge signal to global markets.
But signals only go so far if the businesses aren't performing. Let's talk about the engine room here. You can't talk about the Korean market without mentioning the semiconductor giants, right? Samsung and SK Hynix.
The twin engines of the whole economy.
So we know the AI story. Insatiable demand for high bandwidth memory chips. But there's a huge elephant in the room. It's 2026. President Trump is in the White House, and he's been very vocal about tariffs.
And that's the central conflict defining the market right now. You've got this incredible, once-in-a-generation demand for AI chips on one side, and on the other, the threat of U.S. trade barriers, especially on things like cars.
So you have a buy signal from tech and a sell signal from the White House. Who's winning that tug of war?
As of late January, the chips are winning.
How? Usually a tariff threat would tank a market like that.
It comes down to a concept called inelasticity. Think about your morning coffee. If the price goes up 50 cents, you probably still buy it. You need it.
Sadly, yes, that is very true.
Right now, the world needs these specific high-end memory chips for AI data centers. There are only a couple of suppliers. If the U.S. puts a tariff on a Hyundai, maybe you buy a Ford or a Toyota instead. The demand is elastic. But if you need high bandwidth memory for an NVIDIA server, you have to go to SK Hynix or Samsung.
The product is just too essential, so the earnings are powering right through the political noise.
That's the story the market is telling. But here's where the research really surprised me. I always thought of Korea as just chips and cars, but the data shows two other sectors are just exploding. Defense and beauty.
Diversification. They're proving they're not a one-trick pony.
Exactly. Let's start with defense. They're starting to call Korea the arsenal of democracy.
Wow. That's a title normally reserved for the U.S. in World War II. That implies massive scale.
And that's why they're winning. Look at Europe. They need tanks, they need artillery, and they need it now. The U.S. defense industry is backlogged for years. European production is too slow.
And in comes South Korea.
In comes South Korea. Hanwha Aerospace just signed a $2 billion deal with Norway for rocket artillery. A delegation is in Canada right now talking about a submarine deal worth over $12 billion.
$12 billion. That is huge. So why them? Is it just that they're cheaper?
It's not just price, it's speed.
Yeah.
Because of their own security situation, they've maintained this massive, ready-to-go manufacturing base. They can deliver NATO-compatible gear faster than almost anyone. It's like Amazon Prime for heavy artillery.
That's a powerful advantage. Okay, and then on the complete other end of the spectrum.
Yeah.
Face creams. K-beauty.
Don't underestimate the moisturizers. Exports hit a record $11.4 billion in 2025.
I thought K-beauty was all about China, though. And we know the Chinese consumer has been pulling back.
That was the old model. The big pivot has been geography. They realized relying on China was risky, so they aggressively targeted the U.S. and Europe. They got into Amazon, Sephora, Ulta, and it absolutely worked.
So if we summarize the South Korea file, you've got a government actively cheering on the market, a huge pension fund providing support, an indispensable chip sector, and new growth engines in defense and beauty.
Exactly. They are trying to engineer a higher valuation for the entire country. They're on offense.
Okay, let's switch gears. Let's head over to China. And if Korea's on offense, China seems to be digging trenches. The headline from the research is this thing you called a financial airbag.
That's the best way I can think to describe it. The data shows China is considering issuing what they call special sovereign bonds, and the number is just staggering around 2 trillion yuan. That's roughly 290 billion US dollars.
That is a lot of money. But governments issue bonds all the time. What makes this so special?
It's the target. It's where the money is going. Usually when China does stimulus, it's for, bridges, trains, or they just give cash to the big banks. This time the money is targeted at major state-owned insurance companies.
Insurers? Why would you bail out insurance companies?
Okay, to get this, let's use an analogy. Think of the financial system as a house. The banks are the plumbing. They keep cash flowing day to day. If a pipe bursts, the house floods right away. Governments always fix the plumbing first.
Okay, banks or pipes. What are insurers?
The insurers are the foundation. They hold these massive, long-term pools of capital, 30-year promises. They're the bedrock. But right now, in China, that bedrock is under immense pressure from low interest rates.
Right. Break that down for me. Why do low rates hurt an insurer so much?
It's just simple math. An insurance company takes your money today and promises to pay you a certain amount back in 20 or 30 years. To do that, they have to invest your money and earn interest. If rates are near zero, they literally can't earn enough to meet their promises. They start losing money on every single policy they write.
So the government sees cracks forming in the foundation, and they're pouring in cash, like concrete, to shore it up.
Yes. But here's the crucial part. It's not just about saving them. It's about what the government wants those companies to do with that new money. They want these giants, China Life, China Taiping, to act as a national backstop.
Wait, a backstop for what? The stock market.
For the stock market,
Yeah.
precisely. They want these well-capitalized insurers to be ready to step in and buy stocks if the market starts to crash. They provide a floor.
That creates a really strange dynamic for an investor, doesn't it? If I buy shares in one of these companies, am I buying a business that's trying to maximize profit for me? Or am I buying, well, a tool of the state?
And that is the billion-dollar question. This is what you might call national service. These companies are being strengthened, yes. They're being given a huge advantage over smaller competitors. It's a K-shaped strategy. But their number one mandate might become stability, not maximizing your dividend.
So if the market is tanking, they could be ordered to go in and catch a falling knife, even if it's a terrible financial decision for the company itself.
They are the designated safety net. And if you invest in them, you're betting on the government's ability to manage a crisis, not necessarily on that company's ability to grow or innovate.
It's fascinating when you put these two stories side by side. We always talk about the invisible hand of the market.
Yeah.
Adam Smith let the best company win. But in 2026, Asia, that hand is very, very visible.
It's extremely visible. In both cases, the state has decided the market just can't be left to its own devices.
In Korea, the state is the cheerleader in chief. They're shouting from the rooftops, "We are undervalued. Buy our stocks." They're moving their own pension money to prove their point.
And in China, the state is the structural engineer. They're looking at the blueprints of the whole system, seeing a weakness in the foundation, and issuing massive debt to make sure the building doesn't collapse.
So for our listener, let's call them the learner, who's just trying to make sense of this. What's the actionable takeaway?
I think the takeaway is that in 2026, especially in this part of the world, you can't analyze these markets with just a spreadsheet. You can't just look at PE ratios. You have to analyze the policy.
For Korea, that means looking at the quality of those earnings. Is this AI boom sustainable? Can the chip sector really outrun the trade war talk?
And for China, it means looking at the structure of the capital. You have to understand that the government is the biggest player at the table. So the downside is probably protected. They won't let the system crash. But the upside might be capped because stability is the goal, not runaway profits.
You know, it reminds me of a thought I had reading through all this. We tend to think of free markets as like wild jungles, survival of the fittest.
But in Asia right now,
It looks more like a carefully tended garden.
that's a perfect image, a very carefully tended garden.
You've got the gardener, the government over here, pruning this branch, watering that one, putting a fence around a plant to protect it from the wind. They're actively deciding what grows and how fast it grows.
And the question for you, the investor, is, do you trust the gardener?
Do you trust them to keep the plants alive? Or are you worried they might just prune the very branch you're standing on?
That's the question to chew on this week. Are you betting on the individual plants, or are you betting on the person holding the shears?
Something to think about next time you check your portfolio. That is all the time we have for today's deep dive into the Asian markets. We hope this cleared up some of the headlines for you.
Thanks for listening.
Don't forget to subscribe and hit that like button. We will see you next time on Investment Insight.